Hi, my name is Morten Frederiksen, and I work on the research team at Pitcher Partners Investment Services in Melbourne, where I also oversee our responsible investing initiatives. Over the past few years, we've seen a rising level of interest from clients on the topic of responsible investing, and this has been mirrored by a rise in interest, investment flows, and products available in the general market. To help us delve deeper into this topic, we're joined today by Tim King, the Chief Investment Officer at Melior Investment Management, a leading equity impact fund based here in Australia. Tim has over 25 years of experience investing in markets and was a co-founder of Melior, which was set up to focus on investments which can generate a positive impact to society. Welcome, Tim.
Thanks, Morten. Nice to be here.
Now, Tim, there's been a huge attention to the responsible investing space in recent years. Can you explain the difference for our audience between responsible investing and impact investing, and what each of them means to you?
Responsible investing is an umbrella term for quite a wide range of strategies, and sitting within that is impact investing. But maybe I'll just sort of explain the breadth of the strategies and sort of how they fit together. So at one end of the spectrum, so one end of the spectrum is impact investing, that's us, and the opposite investing is sort of ESG investing, to the extent that when consideration is made for investments, there's some consideration of the ESG impact of the investment, and that's about it, right? So next one along, and this is very broad brush, right? But next one along is some negative screening. So simply extending that ESG sort of consideration to actually screening out certain industries. So maybe excluding, companies that source X percentage of their revenue from tobacco or X percentage of their revenue from fossil fuels. So that's sort of the next one along. And then there's a whole series of different investment strategies, from sort of best in class investing. So sort of take the companies in a particular sector with the best ESG credentials, invest in those. Sort of ethical investing with some ethical overlay. And then right at the other end is impact investing, which is quite a new concept in public equities. And I'll talk about why that's the case. And that's about actually generating change through the companies that you're investing in. So there's actually a delta involved in that, and that involves extensive engagement with companies, which I can talk about. So it's quite different to, sort of the first sort of ESG products we saw in the market were those negative screens, right? It was a very, very basic sort of product. So this is much more sophisticated and really takes ESG investing to a new level, impact investing in public equities.
What are some of the biggest misconceptions you feel about impact investment?
I think there's two major misconceptions. As I said, impact investing in public equities is a very new concept. And it's this question, can you actually create impact in public equities? Now, the reason for that, one of the reasons for that is, let's distinguish between private markets and public markets. So the notion, there's this question of additionality. So, through your investment, how are you creating something different, right? That's the additionality. So the idea is, in private markets, somebody invests in a particular project, and without that capital, that project wouldn't have got up off the ground. So let's just say it's a solar farm. So that's capital additional. However, I think that's a bit of a misconception, because it's like, well, if that project's generating appropriate rates of return, well, someone else would have invested in it anyway, right? So it's not as if your particular capital is unique in that private market. So whereas in public markets, clearly we're buying and selling stocks on the stock exchange. That's clearly not a capital additional. But as I said, I don't think there's actually a distinction between private and public markets in terms of that capital additionality, although people still think there is, right? But where the additionality, where the change is generated, is through engagement with companies, right? From board to C-suite, but extensive engagement with companies about driving the positive change that we want to see, right? And so that's a very complicated process. It requires a lot of engagement with companies, as I said, at the highest level, and a deep understanding of those companies. So that's how the additionality occurs in public markets. The second big misconception, and this is not just confined to impact investing, but ESG investing more broadly, is that you have to take a haircut on returns. And simply the evidence is absolutely to the contrary to that, right? Yeah. The evidence is that companies that have good ESG credentials, have a lower cost of capital, have significantly less regulatory, reputational, legal risk in their businesses, and they will outperform through time. There's very clear evidence of that. So I think, there are the two key misconceptions, but I think they're being progressively dispelled. And certainly in our particular case, we've significantly outperformed the market. So we were launched in 1st of July, 2019. As of 31st of December last year, we'd outperformed the ASX 300 benchmark by just over 19%, right? So our experience has been of outperformance. As I said, that's certainly the evidence, both academic, empirical evidence that companies with ESG credentials will outperform.
Okay, thank you. We've seen in recent years a rising demand for things like battery materials. Obviously, it's been in the press a lot in this sort of process of a clean energy transition. But how should investors reconcile holding mining and resource stocks in a responsible investing or an impact fund?
There's quite a few elements to this. First of all, companies, so mining companies do harm, right? But clearly, they cause harm to the environment and potentially other things on the land they're operating, right? Because they're digging up dirt. But every company causes harm, and that tends to get forgotten about, right? So, we need pharmaceutical companies, for example, to produce the products for our health. All those companies test on animals, right? I mean, they have to. We know that. And so all companies cause harm of some form, number one. Number two, it is actually possible to mine responsibly. So those companies that for example, have responsible rehabilitation policies, rehabilitate the land they're working on, companies that engage positively with their local communities to create employment and so on. It is actually possible to mine responsibly, right? Do all mining companies mine responsibly? No, they don't. But you could find irresponsible companies in every sector. Number three, those materials you talked about, the key materials for the energy transition: nickel, copper, lithium, cobalt are the key ones. If we don't mine those materials, we're locked into runaway climate change. It's just very clear. We need those materials for batteries, for wind turbines, for energy reticulation, for solar panels, so on and so forth. And there was a World Bank report in 2020, which showed that even if we had 100% recycling rates for those products that have already been produced, and we don't, unfortunately, and recycling is clearly part of the solution here, but let's just say it was 100%, we would still have significant excess demand for those particular materials because of the climate transition. So we think it's absolutely imperative to invest in companies that are mining those materials responsibly.
Yep.
Not for the record, thermal coal mining companies, because we don't need to invest in those, but the companies that mine critical materials that are needed for that energy transformation. So it's actually a very, very important thematic, we think.
Okay. All right. Thank you. Like many, we here at and yourselves in as well, we at Pitcher Partners Investment Services in Melbourne have joined some of the responsible investing organizations that are out there. But can you tell us how that cooperation within these organizations works, and where these bodies can really add value to investors like yourself and ourselves?
The main benefit, Morten, is knowledge sharing. This is a very fast move across the ESG spectrum. It's a very fast-moving space, and a lot of developments happening really quickly. And I'll give you an example. So we're members of the Responsible Investment Association of Australasia, RIA. We have this new framework called TNFD, Task Force on Nature-Related Financial Disclosure. It's a mouthful, which is developing a framework to measure, monitor, and understand the risks and set targets for biodiversity restoration, right? It's a very complex framework that's being developed. It should be launched early 2023. Now, we've set up a working group's been set up by RIA. This is a global initiative, right? Because it's a global problem, biodiversity loss, but the issues are very local, right? Because biodiversity loss, for example, in New South Wales is very different to the problem in, say, Western Australia, which is very different to the problem in parts of Europe or whatever, right? So yeah. We've set up a working group here, and we've divided that into a series of sub-working groups. I chair one of those sub-working groups. It's called the Risks and Exposures, and we're examining the risk and opportunities, the risks and opportunities for companies from this development of TNFD, and that's so the wider working group. There's a lot of bodies involved, that not just institutional investors, but scientific bodies and so on, and we're basically knowledge sharing, and so the work we're developing will plug into the global TNFD initiative and aid in the development of that. So I think it's a really good example of how these sort of organizations can be really beneficial, pulling everyone together to share their knowledge to the benefit of the development of responsible investing.
In our research and integration of responsible investing into our existing process, I mean, data has been a bit of an ongoing issue, and we found challenges integrating the data and information as viewpoints are differing quite widely depending on which contributor you might be looking at which point in time. So how do we best make use of the data and information available and get an informed view that we can make an investment decision based off?
First point, I think we do our own work, right? So there's a whole bunch of ESG data providers out there. We don't use them. And the reason we don't use them is because there's a lot of variability in the data, right? And we think just like we do our own work for financial analysis, we do our own work for ESG as well. So just to give you an example, there is no standard definition of what net zero means, right? And so there's a lot of different claims by companies as to their net zero claims. But some of those are true to label. In other words, they're Paris aligned, and some of them aren't. You need to do your own work on that. You just can't take that label and say, yes, this company's Paris aligned because it said it's net zero, right? So very important to do your own work. Integration is key. And the way we do that is we don't, so many fund managers outsource, they have an ESG person that sits outside the investment team. That's not the way we do it. The way we do it is fully integrated. In other words, a company responsible, an analyst responsible for researching a certain company is responsible for both the financial aspects of the company and the ESG, and then they understand how the two interconnect, because it's very difficult, if not impossible, to do that otherwise, because it's like, how do you plug in this ESG data set into the financial data set? Because the two are interrelated, right? As I said before, ESG creates risks and opportunities for companies. But I think the real game changer here is, another acronym, and this space is full of acronyms, that's ISB, the International Sustainability Standards Board, which was launched at Glasgow in end of last year. So this is a set of sustainability standards which will mirror the financial standards that we already have in place. ISB has already launched a prototype of the climate standards. So I think what we're going to evolve to here is a world of that we have an audited set of financial accounts and an audited set of sustainability accounts. Now, this is going to take some time, but I think it's going to create a much better set of much more transparent data sets for investors to make their investment decision. We're a long way to go before that, but I think it's going to change relatively quickly over the next few years, where we see that ISB reporting becoming pretty much standard for companies to report on.
I mean, obviously that brings a lot of challenges, not just for, I suppose, investors themselves, but also for the listed corporates
yes.
who have to report on this information and make sure that the information is in some way standardized as well. I mean, how do you feel that the listed companies have responded to this surge in awareness and adoption of responsible and impact investing? I mean, what's been your experience in terms of those that have embraced it and those that are sort of, I suppose, a little bit more reluctant?
Well, I think, first of all, I'd say, Morten, that the reluctance has pretty much disappeared, right? Because what our experience has been is that, companies are getting the point that that this isn't going to go away. It's only going to get magnified, and they better start understanding it. So our experience has rather been the companies are very keen to talk about this because it's a new concept for many companies. They often aren't well equipped to deal with it because the concepts are very novel and they can be very complex and it's very fast moving. So we frequently get companies calling us, companies we don't invest in, because they want to talk to us to understand how the concepts are moving. So I've been, as you said at the beginning, I've been in capital markets for a long time in the listed space. When I started looking at ESG almost 20 years ago, it was kind of considered, quaint, right? It's like, who cares about this? That is completely changed. So now it's gone from quaint to actually this is critically important. So what we've seen with companies is that quite a few developments, I think. So first of all, they've started forming subcommittees at board level. So we have a REM committee, we have an audit committee, and now we have an ESG subcommittee in many cases, right? Because they're taking it, this is a significant issue. So they're forming subcommittees. They're hiring sustainability people in the executive team so they can better understand the issues. They're starting to link it with REM, right? And initially that was to STI, but it's increasingly into LTI because these issues tend to be quite long dated. So you'll see quite a few REM reports where the CEO, CFO, and senior executives, where their variable comp is linked to, for example, emissions reduction targets, right? That's increasingly becoming the case. And what we're seeing is that just more and more access to companies, particularly at board level, because, we can talk about what we think those companies need to do to get on their journey. And I think there's an increased realization from companies, Morten, as I said at the beginning, if they do this properly, they actually de-risk their business. It's not a trade-off, right? If they do it properly, they will have lower reputational risk. They'll be able to get better quality employees. I mean, you just speak to, my kids, their generation, they don't want to work for companies that are causing social harm, causing environmental harm, right? So there's a whole bunch of good reasons why they need to take this seriously. And I think companies pretty much are on that journey. Now, most of them have got a lot of work to do, in my opinion, but they're on the journey. Okay. With some exceptions, but that's broadly speaking, yes.
Yeah. No, that's good to hear. That's good to hear. We've witnessed a bit of a surge in flows, as I mentioned before, into the sort of ESG and responsible investing strategies, and being cognizant of, I suppose, broader market dynamics. What do you see as the biggest pockets of opportunity and risks evident within your investable universe today? And is there a risk that market could get frothy within this space because of the level of heightened interest?
Yeah, I think there's certainly, depending on the strategy, Morten, I think there's definitely risk of frothiness. And we've seen evidence of that in the past. And where the sort of single theme strategy of investing in renewables or something like that, it's quite narrowly focused, given, there's limited assets to feed that pool. There's definitely risk of frothiness in that. I think there's certainly risks around sort of jumping on the bandwagon and greenwashing and not actually having a genuine approach, and that's a risk. But I think about the biggest opportunity I see is that the way we invest is just simply sensible investing, right? So what I think is this ultimately, and we've seen the academic evidence out of Professor Colin Mayer at Oxford and Professor George Sarafheim at Harvard, is that you simply want to invest this way, right? So if you invest in companies that produce goods and services that are essential for their sustainable development goals, in other words, they're doing good, right? And those companies do it in the least harmful way possible. In other words, they have good ESG credentials. They will simply have lower cost of capital, as I said, less reputational risk and so on. They will outperform. So what I see is that ultimately, impact investing in public equities just actually becomes mainstream. And I think that's a significant opportunity because there's going to be a whole pool of capital that flows behind that. So,
no, I would tend to agree. I think there's a big amount of impetus within the market to not only look at this, and as opportunities become more broad-based, I think that will hopefully take us along for that journey. But thank you very much, Tim, for taking the time to talk to us today. It's been very helpful and insightful.
Thanks very much, Morten, and thanks again for the invitation. Nice to be here.
Thank you. At Pitcher Partners Investment Services, we offer access to a wide variety of leading investment managers in the responsible investment space, such as Melior Investment Management. As a firm, we continue to invest in and add resources to our growing capability in responsible investing. And we've joined leading organizations such as RIA, the Responsible Investing Association of Australasia. Additionally, we have advisors who are both certified and experienced in providing advice within the responsible investing space. If you wish to learn more or have a discussion on how best to accommodate your beliefs and values into your investment portfolio, please contact your advisor or check out our website. Thank you.